You've been told who runs the world. Presidents, prime ministers, central banks, tech CEOs, billionaires with private jets and public faces. But what if the most powerful company on earth doesn't sell you anything, doesn't advertise, doesn't campaign, and almost never speaks directly to the public? What if a single firm quietly sits behind? The banks you trust, the governments you vote for, the corporations you work for, and the markets that decide whether your retirement survives or collapses. A company so large that, at its peak, it controlled more money than the GDP of every country on Earth except two. A company you've probably never heard of. This is not a conspiracy story. There are no secret meetings in dark rooms. No shadowy villains in cloaks. What makes this story unsettling is something far more dangerous. Back-end index pointing right, everything about it is legal. Back-end index pointing right, everything is in plain sight. Back-end index pointing right, and almost no one is paying attention. This is the story of BlackRock, the $7.9 trillion company that doesn't want to be famous, and the financial system that made it inevitable to understand how BlackRock became so powerful. You have to understand why power stopped looking like power. In the 20th century, power was visible. Oil barons owned oil. Steel tycoons owned steel. Banks owned vaults full of cash. But by the late 20th century, something changed. Money stopped being about ownership and became about management. Instead of asking, who owns the money? The real question became, who decides where the money goes? And that shift would quietly reshape the entire global economy. The 1980s, when finance became too complex. In the 1980s, Wall Street had a problem. Financial products were exploding in complexity. Mortgage-backed securities, bond derivatives, structured debt, risk models stacked on top of other risk models. Banks were making more money than ever, but they no longer understood the risks they were taking. Portfolios had become so complex that even senior executives couldn't explain them. Risk was calculated with spreadsheets and guesswork. One wrong assumption could destroy a firm. And that's where Larry Fink enters the story. Larry Fink's failure. Larry Fink was not an outsider. He was not anti-Wall Street. He was a believer. In the early 1980s, Fink was a rising star at First Boston, pioneering mortgage-backed securities. Then came a mistake, a miscalculation, an interest rate bet that went wrong. Back-end index pointing right, $100 million lost. In today's numbers, that's catastrophic. But the real damage wasn't the money. It was the realization. Larry Fink didn't lose money because he was reckless. He lost money because the system didn't understand its own risk. That failure would become the foundation of BlackRock. Most investment firms sell one thing. We'll make you money. Larry Fink wanted to sell something different. We'll tell you exactly how much you can lose. That sounds boring. It sounds conservative. It sounds unexciting. And that's why it changed everything. 1988, the birth of BlackRock. BlackRock was founded in 1988 with a simple promise. We manage risk better than anyone else. Not higher returns. Not market-beating strategies. Just measurement, data, systems, control. At first, BlackRock didn't even manage stocks. It managed fixed income, bonds, mortgages, boring assets. But under the surface, something revolutionary was happening. Aladdin, the machine that changed finance. BlackRock didn't just build portfolios. It built a machine, a system called Aladdin. Asset, liability, debt, and derivative investment network. Aladdin wasn't just software. It was a financial brain. It could analyze millions of securities, simulate market crashes, measure risk across entire portfolios, stress test the future. While other firms guessed, Aladdin calculated. And soon, BlackRock realized something terrifyingly powerful. Back-end index pointing right, they didn't need to own assets to control decisions about them. The rise, when everyone handed over the keys. The 1990s, 2000s, trust becomes dependence. As markets globalized, institutions faced a problem. Pension funds grew massive. Sovereign wealth funds exploded. Insurance companies handled trillions. But complexity grew faster than expertise. So they outsourced, not to BlackRock the investor, to BlackRock, the risk manager. Soon, governments used BlackRock systems. Central banks relied on its analytics. Pension funds followed its models. BlackRock wasn't making decisions directly, but its models shaped the decisions everyone else made. 2008, the moment everything changed. Then came the financial crisis. Banks collapsed, markets froze, trust evaporated, and governments panicked. They needed someone who understood complex assets, could price toxic securities, had systems that still worked. They turned to BlackRock. The breaking point when BlackRock became systemic. During the 2008 crisis, BlackRock was hired to manage Bear Stearns' assets, then AIG's toxic portfolio, then government bailouts. Think about that. A private firm was advising the government, managing failed institutions, operating inside the rescue itself, not because of corruption, not because of conspiracy, but because no one else could do it. That was the moment BlackRock crossed a line. From participant to infrastructure. Fallout, too big to fail without failing. After 2008, regulators focused on banks. But BlackRock wasn't a bank. It didn't take deposits. It didn't lend money traditionally. It just managed assets. So it avoided bank-style regulation. And it grew. Passive investing, the money vacuum. BlackRock's iShares ETFs exploded. Passive investing meant money automatically flowed into markets. Capital allocation became mechanical. Index providers gained enormous influence. BlackRock didn't choose winners, but it owned everything proportionally. At its peak, stakes in Apple, Microsoft, Exxon, Pfizer, banks, media, defense contractors. Not controlling, but present everywhere. Failed fixes why nothing really changed. Governments talked about breaking up big banks, regulating systemic risk, reducing concentration. But asset managers were left mostly untouched. Why? Because pension funds depend on them, governments depend on them, markets depend on them. Breaking BlackRock would mean breaking the plumbing of global finance. Modern parallels. The pattern repeats. Today, AI is replacing human judgment. Algorithms allocate capital. Risk is centralized again. Different technology, same structure. When COVID hit, governments once again turned to BlackRock to manage emergency bond buying programs. The same pattern. Crisis complexity, outsourcing concentration. The real question, who decides? BlackRock doesn't vote in elections, but it votes in shareholder meetings. It doesn't write laws, but it influences capital flows that shape policy outcomes. It doesn't rule the world, but it helps decide which parts of the world get funded and which don't. 1. Power has shifted from ownership to infrastructure. Whoever runs the systems runs the outcomes. 2. Risk management can be more powerful than risk-taking. Controlling fear controls behavior. 3. The next crisis will follow the same blueprint. Only the names will change. Final warning, the silent trade OFF. Every society makes a trade-off between efficiency, resilience, control. We chose efficiency, and efficiency always concentrates power. The question isn't whether BlackRock is good or evil. The question is, what happens when the system no longer understands itself again, and there's nowhere left to outsource the risk? Call to action. If this video changed how you see the financial system, subscribe, because the most important forces shaping your future are rarely the loudest ones, and the next story is already unfolding quietly.